Hello and welcome, and thank you for joining us on today's webinar called Navigating a Peak Everything Economy. Before we get into it, just some quick housekeeping notes. First off, on the technology front, if you experience any technical issues, please try refreshing your browser or open a new browser in either Chrome or Microsoft Edge. Alternatively, please ask a question in the chat window where technology support can help you. And on Q&A, we are not able to accommodate live Q&A on this particular webcast, but for those who pre-submitted questions, we will be addressing those with Peter and myself at the end. So first off, with introductions, my name is Josh Greco. I'm the head of institutional portfolio management here at Franklin Templeton Investment Solutions. I'm hosting on behalf of Franklin Templeton Investment Solutions, as we are the division within Franklin Templeton responsible for creating multi-asset solutions on behalf of our clients and investing across our specialized investment managers like ClearBridge Investments, who's joining us today. With me on the line, I have Peter Bourbeau. Peter is a listed portfolio manager on the ClearBridge Large Cap Growth Strategies, and we have around 45 minutes today to discuss the ClearBridge view on the state of equity markets and what you should be looking for in your large cap growth managers right now. So, Peter, thanks so much for joining us today. We have a pretty robust agenda of topics to get through. Thank you for bringing some slides to illustrate kind of the key points. And we're going to start off just kind of at the headline here with the state of the economy versus the state of the markets. You know, up until November, I don't want to say we were cruising, but we were making really good progress. We had 60+ new highs going into mid-November, was the most since '95. We had the highest CPI print in 30 years, though, back in October. And we're looking at some uncertainty with Omicron. So how are you reconciling the opposing forces of the economy and the market, and your thoughts on things overall?
Great. Thanks, Josh. Good morning, good afternoon, everybody, and thanks for your participation. Great question to start with. Josh, I'm going to try to run through quite a few slides here. We'll spend our time, and we can always go back if there's any questions. That's what the market's trying to do real time. We're digesting everything that you just said. We're trying to digest, you know, kind of peak everything, which I know is the title of the webinar, which we're going to dive into in a little bit. I think it's fair to say that we've pulled forward returns dramatically. This is atypical than any cycle that we've ever seen. You know, we've got some kind of data to support that. We're punching way above our weight. This chart right here is just illustrative of that point. We've aggregated other recoveries in other recessions, and then we've superimposed the current COVID rally above it. I think it's fair to say that digesting some of these market returns is normal, should be expected. And especially, you know, when you think about all of the tonic that is no longer a tailwind. I'm not suggesting it's a headwind, but we're going to start normalizing all of these peak margins and liquidity, profit margins, economic growth, all to your point, Josh, with whiffs of inflation and higher rates. And that's, I think, why the market has kind of ground to a halt. You know, maybe today's not indicative of that, but the volatility over the last 30 days has been enormous. A lot of countervailing forces. We're just trying to normalize, I think, this giant pull forward. So again, if you just kind of take a look at this chart, it should be expected and normal to kind of tick sideways for a period of time until we really get better sensitivity on where earnings growth is going to end up. If you look at the next chart, you know, what we try to do here, right, the omen, right, is higher inflation, higher interest rates must mean something negative for equity markets. And actually the opposite is true, right? I was taught early that the rates go up for three reasons, right? It's a meltdown in the dollar, which is clearly not helping or not happening. It's higher economic growth, and it's higher anticipated inflation. The last two are not bad for equity markets, and this chart proves that out. Our types of companies love a little bit of pricing power, right? Economic growth, I think it's fair to say that we've healed, right? We're on a better course right now. the Fed and the Treasury really never let us have a recession. I'm not trying to minimize some of the collateral damage, right? But this was atypical than most recessions, and we're gonna try to illustrate that in the next several slides. But the market participation also has been pretty atypical. This is a chart that's pretty amazing. If you look at the last 25 years or so, it's cliche, but money goes to where it's treated best, and this is pretty indicative of that. What we're trying to suggest is that if you look at the last 25 years in terms of total equity flows, it's totaled 180 billion on a cumulative basis, and we've brought in $750 billion in new flows to the market. We know why, right? We're penalizing savers, right? The Fed has forced investors to go further and further out on the whip. The thing that's potentially a little dangerous about this chart, and this is a general comment about market participation, market structure, right? The ebbs and flows of the market has been broken for 20 years. It doesn't function in a normal pattern from when I started my career. 10% of single stock volume today is being managed by active managers. That leaves the other 90%, right, of total volume in a single stock with quants, systematic, factor funds, ETFs, and retail participation, which almost definitionally means that you're valuation insensitive, right? So when you drop a ticket for an ETF, right, you're buying the basket. You're not separating what's expensive and what's not, what's got a higher growth rate, what's got a better business model. So you've kind of dumbed down the process of investing. And this is, frankly, why we've seen as much turmoil, I think, as we've seen over the last 30 days, and probably why it continues, right? You've got market participation that is not tied to fundamentals or valuation at all. And that's why you're seeing these giant swings. So, Josh, let me throw it back to you. But again, we can go back to any of these slides if there's further questions.
That's perfect, Peter. And honestly, that's why you're on the line. You are a fundamental active manager. It has been ClearBridge's hallmark for decades. And those type of diagnostics, that 10% of folks determining single stock value, like that's the stuff that we want to hear from you, and reasons why we advocate and believe in your strategies. And this slide right here on equity flow, I think that says a lot. I myself have put some equity money to work this year, so part of the problem, perhaps. But certainly emblematic and a good snapshot of what's going on in the market. Let's kind of keep talking about the market. You've talked about kind of the dynamics this year, but let's talk about specifically some large cap opportunities. It's been an interesting year, almost a year of two halves, where we saw value style really winning from January to early June, and then you're going to see growth really coming on strong in that later part of the summer, right through November. And so, what did you and your strategy sort of underestimate in the first half of 2020, and how have you taken advantage of some of this volatility we've seen lately within your strategy?
Yeah, good question, Josh. And kind of pointing to one of the first slides that we had, this has been anything but typical in terms of a drawdown and a recession. And if you think about the Fed and the Treasury, they treated COVID like a natural disaster. Than a typical recession, right? You had different tools, you had vastly different speed in terms of implementation. And what we're trying to show right here is how dramatic that influx of liquidity and support has been. We aggregated the last 5 recessions and combined the programs that the Fed and the Treasury stood up, and then we superimpose the current COVID crisis and the programs that we stood up, and as you can see, it's unlike anything that we've ever seen. It's been a tsunami of cash, and that's frankly supported the system, right? We didn't crack. We had a recession, right? The duration of a cup of coffee, and we've been up and to the right ever since. Traditionally, what recessions do, right, is you back test, right? You have kind of that dead cat bounce, right? And then the recession is underwritten, and then you kind of pick your winners and losers in the cycle, and then you're kind of on to the next cycle. And like I said, the Fed and the Treasury never allowed that to happen, right? And so this won't be repeated, though, right? This level of liquidity will never be repeated, certainly in this cycle. And this is kind of part of that peak thesis, where you're going to have to really underwrite some other version. And clearly, with Fed Chairman Powell being a little bit more hawkish on inflation, right? He's retracted his transitory comment. I think it's fair to say that he's going to go green on pulling back stimulus. Still super supportive from the Fed's balance sheet, but the rate pull forward, if you look at the curve, is suggesting that rates start moving faster and sooner. I would just say, objectively, right? If you just kind of were an investor and you descended from Mars and you look at that Fed policy today, does that foot with reality? And this is kind of part of the last 45 days. The answer is unequivocally no, right? You've been too generous, right, with the programs. You've been too generous with pinning the risk-free rate, right? And it's time for to kind of let the price takers make their investment decisions. So the market's struggling with this right now. You're removing the support and the training wheels, and the market participants are really trying to figure out where to go next. The other point, Josh, is, and by the way, if we could have updated this through last week, it'd be even more dramatic, and that is that the average stock has gotten clobbered. And that's not just really within technology, right? We've had kind of a rolling capital markets correction that is being kind of obfuscated with just the very large names in the benchmark, that's not really painting the picture as we see it, right? You've seen a lot of SaaS and expensive tech, or frankly, tech that has no profits or cash flow, down 30 to 50%. And this pretty much foots with what we thought was going to happen when the whiffs of higher rates normalized. But the damage underneath the surface has been dramatic, and like I said, if we could take this a couple weeks out, it would be even more dramatic. We've taken advantage of this market opportunity the best we can, right? We're your kind of core growth manager. We're not momentum investors. Certainly, we have some exposure to some of these expensive tech, but in this process, right, we've initiated new positions in big chunky things like Intuitive Surgical, Netflix, which is a name that we're certainly all familiar with, Nike on that giant pullback with the kind of the Western boycott of goods and services, along with COVID manufacturing out of Vietnam. We've also been aggressive in trimming that tail, those positions in the portfolio that, as we squint and look out 3 to 5 years, right, are probably not going to be participants in how we see the world shaping up. So the last 2 years, they're in the books, right? We've had an explosion in liquidity. All that abates, right? And it's time to start looking at the next cycle. And that's part of what Margaret and I are trying to do, is really pull forward our assumptions of where you want to be and how you want to be positioned. So, Josh, I'll throw it back to you.
Yeah, and Peter, I think we're teeing this up right in this slide that you just put up on screen. So we've talked about, we have huge equity flow, peak flow. We have huge fiscal stimulus, peak stimulus, and you've mentioned sort of how some of the bigger names have just been so influential in what's going on in the market. And that last slide actually just showed us like subterranean kind of what's going on with the average stock. Let's focus on these exceptional names that you have on this slide here, because in the large cap space, your performance has been determined by as much of what you don't own as what you do own when the market is this concentrated amongst the names you see here on screen. So let's talk portfolio drivers on this slide, Peter, and show us how concentrated this index is and what's moving the large cap space.
Yeah, no, it's a great point, Josh. It's as important as what you don't own, right? So this is my 30th year in the business, and we certainly lived through the late 90s with extreme concentration. This is quite a bit different, right? And it's different because if you look at how profitable these hyperscale, enormous tech companies have become, right? And it's the reason they've got a cross mark on their back from regulators and politicians. It's because they've extracted enormous profit pools. The economic rents are very different from the late 90s. And it's amazing how disruptive the disruptors have been, right? If you look at how we view tech and call it shadow tech, we're at 65, 68%, right? And theoretically, a diversified benchmark with 450 names, right? You have 5 names that are 40% of the bench. We've never seen anything like this, right? Now, again, with that and what's followed, right, is giant cash flow growth that is supportive, partially, of some of the valuations. In some cases, right, the durability of some of these names becomes self-fulfilling, right? It's easier to attract talent when you have a stock price going higher, right, and you can pay. It's easier to put pressure on vendors, right? It's easier to grow your profit pool, and then that cycle repeats. And this is why politicians and regulators are going nuts, right? Because the big seem to get bigger. Innovation is trapped within many of these companies, and again that thing becomes self-fulfilling. I would say that I don't see this environment changing an awful lot. The things that have changed, right, is the appetite for M&As probably changed forever. You've got some fairly hostile people in DOJ and FTC that probably aren't going to allow this. But you're always going to get paid for innovation. We're doing a lot of work internally on what we call kind of Web 3.0 and Meta, and these are great catchphrases and so forth. But if you think about Web 1.0 in the late 90s, Web 2.0, which is kind of where we are right now with very large operating systems and then app stores, Web 3.0 is going to kind of destroy that model, and it's just going to look quite a bit different, right? So the economic rents are going to change from the incumbents to the challengers, and that's going to be the fun part, is uncovering what we see in the next 5 to 10 years is really a generational shift in mobile computing. So that's what, as I mentioned, Margaret and I are focused on. You brought up the kind of the difference between growth and value, as illustrated by PEs. This is, and then, we can, let me leave it there, Josh. We can kind of, maybe move on to the next question. But I would just say that don't expect this previous chart to change an awful lot. Multiples will probably be held by many of these hyperscale players, and you just have to be a little bit more cautious, right? The price of failure, as we've seen over the last 3 weeks, is extremely high, right? I don't remember a period of 20 and 30% single stock drawdowns in a day in the last 10 years, right? So people are shooting first, asking questions later. But we're going to have to kind of pay attention just to the overwhelming size of technology within a theoretically diverse benchmark. And sorry, just the last thing I would say is some of these hyperscalers and giant names, right? You continue to innovate, but you're also hitting targets with huge success. So if you look at the right column, Amazon has created 3 businesses from scratch, but you're going after giant targets, right? So whether it's web services, whether it's retail, or whether it's advertising, right? Alphabet turned advertising, generally speaking, along with Facebook, completely on its ear, and the share donors have been enforced for 15 years, right? Traditional media, linear broadcasting, all of these profit pools get de-spec'd every single day. Tesla, whether you agree or disagree that it's kind of a small company in terms of global production, what they've done is they've changed the narrative, and you figure every single global OEM is all in, right? This is going to be a fairly magnificent thing to watch, and I like to call it our industrial revolution of this migration of internal combustion to EVs, and you're never going to go back, right? Unless maybe oil goes to $2 or something, which is not going to happen, right? This trend is certainly in place, and then Netflix, right, operating a streaming service at scale globally. The disruption is still, in our opinion, early days when you can leverage content across the planet and keep building users and have a little bit of pricing power. So I just wanted to put finishing touches on that slide, and I'll send it back to you, Josh.
And perfect finishing touches indeed. And Peter, I love talking with growth and technology investors in general. I took down a couple brand new terms for me. Hyperscale, shadow tech, and share donors are terms I'm going to try to work into any updates I'm giving for the remainder of the week here. But so while new terms, I do want to talk about new firms. So these are like the monster incumbents that everybody knows in the tech or shadow tech space. But there's been huge appetite for growth and growth style stocks this year in general, especially lately. It's been such a hot year for IPOs. If you combine SPAC and traditional IPOs, we're at the highest levels since '95. So tons of new ideas are becoming available to investors as they're trying to disrupt. Side note for anybody who read the Wall Street Journal today, big feature article on how NASDAQ is actually outperforming NYSE for listings this year. I think it'll be the third consecutive year they pulled this off. But there's been something for everybody this year. You have Rivian, which is on the EV tech. We were just talking, or EV side, we were just talking about Tesla, Robinhood, Bumble, Krispy Kreme, something for everybody. But the appetite for new ideas is there. So within tech, let's talk about kind of the exposure you want to have over the next 5 years. And I think you have a pretty illustrative chart on here, which shows a pretty strong trend.
Yeah, it's pretty amazing if you dissect this a little bit. Just to quickly comment, right, on the flood of liquidity into SPACs and IPOs. A little bit of caution is probably warranted, right? You have 40% of all public offerings that have broken, syndicate bid, and SPACs. I don't really have a view on most of them. I would say as a betting man that you're going to have a substantial amount be zeroed out at some point. The path to the public markets, isn't always easy, and the SPAC market has encouraged business models that maybe aren't as hardened as the IPO market, right? Disclosure and so forth. So I think caution is certainly warranted on one or both of those ways to market. This is, like I said, pretty amazing, and largely a function of rates, right? If you plug in some of these long-tail growth names and change your discount rate to zero or next to zero, it's spitting out big numbers. I can't tell you how many times I've heard from the sell side, right, that 30 times revenue is the new 10 times revenue, which definitionally is just a factor of rates, right? So that's not 30 times cash flow, EBIT or earnings. That's 30 times revenue, and that's frankly where the market got a little bit upside down over the last couple of weeks. Some of these unprofitable tech names, and any cracks, and you're getting demolished. So I have taken issue with that comment for quite a while now, and it's kind of coming back to roost. The thing I would encourage people to take from this chart is many parts of the cycle are deeply discounted, but our base case happens to be, right, that economic growth is going to slow dramatically from here. If you look at the Fed dot plots, right, by the end of next year, you're back to very low single-digit U.S. growth. If that is the case, you're going to pay a higher multiple and a premium for what growth is out there. So I expect these lines to converge. I just don't think they're going to go anywhere close to maybe what people are expecting. So our opinion, and this isn't a selfish comment, is that growth should still outperform value. You just have to be careful with where in the growth continuum that's going to come from. But this is also kind of late cycle behavior. It screams of balance and diversification, right? This is back to the original point. We're trying to be your core growth manager, right? We're not your momentum or relative strength manager. And balance and diversification, if you kind of look out the next 2 or 3 years, I think is going to be warranted. Like I said, the economy is recovered, right? It doesn't support the current Fed or Treasury policies as we see it, and I think it becomes where Margaret and I sit more about thematic investing, right? We briefly covered this movement of internal combustion to EVs. Netflix is not the only streaming survivor, but the profit pool globally for the way you consume content, if you believe that Netflix is only 6% penetrated, fair amount of winners, but the business models are really upside down for the old guard and old media. I mentioned intuitive surgical is a relatively new name. Robotic surgery, whether it's in residency or med school, this is in terms of soft tissue. There's a new way of doing what has been done laparoscopically or through open surgery. That's changing forever. The opportunity in robotic is going to be amazing. And then retail, right? Amazon has famously said that you've pulled forward, call it 3 years of e-com into 6 months. It gets a lot harder from here. Amazon is effectively applying a tax, right, to all other retailers, right? Most retailers do not want to sell online. It's unprofitable for them. It requires a different set of skills and a different labor model. And that's a tax. Now, some are going to be more successful than others in omni-channel, but the distance that Amazon is putting on competitors, whether it's selection, price, or this last mile, is cemented, and everybody is just going to have to play catch up from here. There'll be other survivors, and we own things like Ulta and Tractor Supply, Advanced Auto, and Home Depot. But many others are going to struggle with this transition that, like I said, has been pulled forward, and it's permanent, and it's just going to become more punitive. So I'll leave it there, Josh.
Yeah, and let's keep going though on this concept of expectation management and kind of where are your performance expectations for a strategy like this, and how are you managing the portfolio to behave? I can tell you, I know why we own you. In our multi-asset products for the reasons you articulated. Your approach within the growth space is something we appreciate, but some more color on expectation management here.
Yeah, this is a historical chart of what's worked and not worked during a downturn. As I mentioned, the things that have changed over the last 30 years, I alluded to that market structure is really quite broken, and the level of market participants has never been larger other than active management, right? I mentioned systematic and quant, CTAs, ETFs, and then retail. Retail is as big a force as anything that we've ever seen, right? Retail's backstopped some of our trades that we do in SMAs and institutional. So they are an enormous force that you have to appreciate. Large cap, generally speaking, and for the reasons, right, that they don't have a stretched balance sheet, right? They usually have excess cash flow, right? And they've got business models that are asset light and a little bit more subscription based. Not all, but most of them. This is why large cap growth stands up better than other asset classes during a downturn. The other thing is pretty obvious, right? When like I said, we're aiming to be your core growth manager, and with that, we haven't been tested in many years, right? If you kind of look at the previous decade, when what we would call a normal market cycle, the product did well in a world that we thought was maybe more appreciated by the capital market participants. This has been anything but normal, right? Over the last 2 years, it's not our market, clearly, right? We have a tracking error of 4, not 10. And so this has been a period that we lagged. But when we do get tested, right, we for instance, this last 30 to 45 days, we've put a lot of ground in terms of relative performance on our peer group. And it's the distribution amongst market leadership is changing. And I think it's early days. It's early days for that, right? That gift of liquidity and low rates is ended, right? We're not gonna repeat that unless there's Armageddon. And so if you believe that there are whiffs of inflation, I would argue it's a lot more than just a whiff. Naturally, rates are going to move higher. And again, this is perfectly natural and perfectly expected, and that's what the market is digested. But this is suggesting that in the big drawdowns, our batting average is very good in terms of holding up and adding relative performance. And like I said, that's been a benefit to the strategy over the last period of volatility.
Yeah, clutch is how we would define that. Stepping up when you needed the strategy to do just that, and so helpful. And back on slide 9, that's counterintuitive to a lot of investors as to when growth style outperforms. It's when things are slowing down, and you see the investor appetite for organic growth, for companies that can achieve results on their own, stepping up. So when I go through this and how we position multi-asset or multi-style with investors, and I really key in on this point, it really resonates. It's a bit counterintuitive, but something I thought was worth revisiting here. So super helpful on cycle dynamics, as well as when your portfolio steps up to show its thoughtful construction. And, you know, we're doing a December webcast here. It wouldn't be a year-end webcast if we didn't ask you to pull out the crystal ball, Peter, and talk about the future and kind of what you're looking forward to most next year and what we should be looking for in our large cap growth managers right now. Right. So hopefully the one thing that viewers can take away is this has been anything but typical in terms of a drawdown, a recession, and a recovery, right? This has been fueled by ridiculous amounts of stimulus and support. And this is a busy chart. I would just point you to typical drawdowns, and then you kind of look at the far right, where the majority of the returns in this cycle have been through multiple expansion. I can, with a lot of confidence, suggest that is not going to repeat. Right, this is that pull forward that I was talking about, and the title of this slide is the baton moves to earnings growth, and back to that chart from previous couple pages. Organic growth in this environment, as economic growth starts to slow, I think will be priced at a very nice premium. Earnings have to move in conjunction. That's the debate, right? What is the earnings growth? And I'm not talking about for the balance of this year and into next year, right? But you're going to have higher input costs. You're going to have higher taxes, right? You're going to have interest rates, right? Or so the price of money is going to go higher. So and then, oh, by the way, you're going to have costs for the most part increasing, right? Software companies are finally letting salespeople travel. Right, so your OpEx budget, right, your T&E budget, everything is kind of going in the wrong direction, right? It's positive for the economy, right, but it's kind of negative for profit margins. So this is the thing that Margaret and I are spending a lot of time. We are working off the assumption that multiple expansion is forever done, and now you have to look at those that can produce earnings growth in a world where you're slowing, and profit margins are going to be under assault. So I would just suggest that it's just going to get a heck of a lot harder from here. Stocks shouldn't trade in the kind of this monolith fashion that they're traded in right now. Business models are going to start to separate, and that's usually the environment that active managers do better in. The other thing on the positive side, there's two that I want to highlight. This is kind of back to the atypical support that we've seen. You never really had consumers act like consumers, right? And pull back on spending, exhaust their savings. This has been the complete opposite. You've never been more flush
as a consuming society as where you are today, right? The accumulated savings, you can pick a number. It's something north of $2.5 trillion. The ability to pay, credit quality is at a generational high, and delinquencies and charge-offs, right? You kind of comb through bank footnotes. It's really, really good out there. And it's a question of what the spending appetite is going to be for individuals, right? But credit risk is not on the horizon today. Certainly, we're going to have to deal with the credit cycle at some point. But this is, like I said, extremely bullish. If you think about what low rates have done, right? You've inflated a giant bubble. I think this is what Federal Reserve and the heads of the Fed have always tried to do, whether it's Bernanke, whether it's Greenspan and Powell, right? You try to inflate bubbles, whether it's housing, equity markets, whatever risk appetite and risk buckets you think about. They try to sustain a higher value for risk assets to make the recovery self-fulfilling. If that does work, then the Fed will have done their job. So this is going to be something to watch. The other thing that I think we can all appreciate and we read about every single day is how brutal the supply chain is today and how drawn down inventories are. This isn't just about autos, right? You go down the interstate and you see all the dealerships with less than 30 days of inventory when it should be 90 or 100 days. This is everywhere, right? The out of stocks in retail kind of four-wall stores is as high as it's ever been. We spent 40 years getting to just-in-time inventory and we blew it up in 6 months. The problem with that, right, is that this is going to be permanent change, right? There's business risk in terms of where you source your materials. You need a second source now. You need to think about your trading partners, right? Is China really going to be your partner, right, in the next cycle? It's unknown, but I would say probably not, right? You have to start thinking about other trading partners. National security, right? Semiconductors are now viewed as national security, and that's bipartisan, right? So that's also something that is going to be of utmost importance, and you start looking at some of the tax gifts for homegrown semiconductors and fabs. It's early days here. Onshoring, I mentioned, you're not going to trust your non-U.S. manufacturers. You're going to start bringing a lot of production back onshore. It's good for jobs, it's good for the economy, and it's good longer term for inventory. You have to get inventory much, much higher. And this is a gift that's going to keep giving. This is kind of a 2 to 3 year phenomenon that should favor quality industrials with high levels of organic growth. So that's something that we're watching, right? So it's the kind of the consumer balance sheet and the fact that inventories and industrial production, I would argue, is going to compound out at a higher rate for a longer period of time.
And Peter, we didn't talk about this before the call, but literally before we got on this, I was having a conversation with one of our folks in research on the inventory cycle. So I'm really happy that you brought this up. It's certainly something we're thinking about here. And you talked about the consumer. So important for our economy, huge driver in the consumer health that we're seeing is very bullish, as you reiterated. So we hope we gave folks a lot to think about and consider and touched on a lot of the areas that we know folks are thinking about. And so let's get to the pre-submitted questions, and thank you for folks who sent them in. We have about 5 minutes, Peter, so we'll be asking you to keep the answers super tight. First one up here, what event has the biggest impact on your earnings projections? Is it rising interest rates or inflation?
It's probably inflation and those companies that have pricing power. I think rates are going to impact multiples more than anything, but in terms of the bottom line, cash flow and earnings, it's really going to be about whether you have the ability to price over costs. The one thing I would say, and this isn't meant to be critical to the Fed, but if you're paying attention, right, and you're talking to Sherwin-Williams and UPS, right, and Grainger, costs are expected to go up. They're expected to pass through. And this is going to find its way through PPI and eventually CPI. and it's not reversible, right? Labor is not going to get repriced every quarter, right? Labor, for the first time in 40 years, has the advantage, and as does a lot of other companies that deal with engineered products. So you're going to have higher inflation, and that is not going to be reversible, and it's going to find its way into the market. So I would say inflation. Sorry, I would say that, yeah, inflation, much more than interest rates, is impacting how we view the earnings power.
Okay, great. And keeping the rapid fire format here, comments on Alibaba, China in general.
Yeah, Alibaba has clearly been a very, very disappointing name. What we struggle with is uncovering what's new, right? So Gary Gensler came out last week, and basically he is applying the law that Congress wrote about delisting if you are out of compliance with kind of the accounting rules that we require, right? The clock starts. There'll be a 3-year delist. It's going to be a negotiating tactic, right? If you believe that the discussions with China are going to thaw, and we have multiple years to figure this out, right? This isn't kind of an ephemeral point in time. We've got time. This is kind of table stakes in the negotiating process. China does not want their unicorns to delist from the U.S. or from the Western markets, right? It's access to capital. It's access to a shareholder base that they wouldn't have if they are strictly listed in Hong Kong. So the drawdown has been meaningful. Alibaba right now trades for 12 times earnings or 8 times EBIT, which is probably 50% that of names like Coca-Cola and Colgate, and you're growing 4 times as fast. So it hasn't mattered, right? And that's been our frustration. Fundamentals really haven't mattered for Alibaba. I think that they're going to, once China, and they were a little bit more conciliatory over the weekend, kind of suggesting that that's why Alibaba moved 11% yesterday. So we feel good about Alibaba. It's the unknowns that kind of keep coming up, and that's been the frustration. But it's completely detached from valuation or fundamentals. And if it gets back on track, the stock should count much higher. And even applying a discount because of potential regulatory overreach. On Alphabet, wonderful company. We don't own it. We owned it for many years. We sold it last year. The only comment I would say is that they're over earning, and you expanded margins something like 600 basis points over the last year to 18 months. That's not repeatable, right? They're underspending on their costs against that revenue growth. So it's a fantastic company. It's growing 3x that of the S&P. But caution that costs are going to have to increase significantly to kind of catch up with revenue growth. So that's the thing that I think the market's going to have to figure out, right? When you have a tech company with margin compression, what happens to the multiple? So that's our only concern on Alphabet today.
Okay, and last one for you before I close us out here. Just final comments on performance this year relative to the large growth index and how you're positioned to go forward.
Yeah. I hope it was clear that this has not been our type of market. Our process hasn't been tested. When it does get tested, and we saw this in February, April, where we picked up 300 basis points of relative performance, it's being tested right now where we've picked up quite a bit of ground relative to our peer group. The process works, right? We just haven't had enough test cases to prove this thing out. I would just say that, to kind of underwrite more of the same, your assumptions on your inputs can't change much, right? That means that interest rates have to be super low for a lot longer. You need to have a super accommodative set of policy tools. Costs cannot go higher. Taxes can't go higher. Economic growth has to continue to accelerate. These are all things that just kind of based on our work, right? We put a very low probability on. So you have to start thinking for the next 2 to 3 years, what is the market environment, what is realistic kind of global growth, profit margins, and inflation, and this should influence your decision on a go-forward basis. So this year, it's not been good on an absolute performance, right? It's been a small handful of names that we don't own, right? Alphabet being up 70%, right? Tesla doing kind of what Tesla does. It's frankly been kind of two names, maybe throw in Apple, where we're underweight. These have been the majority of the detractors in performance. Stock picking has been good in places like industrials and retail and healthcare. We just need more of that, and we need the distribution of returns, which we think and feel are going to happen over the next 2 to 3 years as naturally the economy slows, and that hopefully will be that will be how we get measured.
And that's how we put money to work, Peter. Looking forward, not backwards. So I like that last comments in the market we should expect and how we should expect companies to perform. So thank you for joining us today. I hope our listeners really took a lot of value from this call. And for any follow-up questions on the clearbridge strategy, please reach out to your Franklin Templeton Senior Advisor Consultant for more information on how to access it. I hope everybody on this line has a safe and productive day, and we'll talk to you all soon. Thanks again, Peter.
Thanks, Josh.